Hi, I'm Tom Lydon, editor of ETF Trends, and I'm at the Morningstar ETF Invest Conference in Chicago. With me today is Russ Koesterich, who's the Global Chief Investment Strategist at BlackRock. Russ, thanks for taking some time to be with me today.
Excited to be here.
Listen, I've got a couple questions. First, what's your biggest concern as we go through the election into the end of 2012 and 2013? Advisors are concerned about the potential with the markets and maybe the fiscal cliff, taxes, new administration. What are your biggest concerns?
It is the fiscal cliff, which in some ways is interesting because you'd think with all of us talking about it, with all of the articles published about it, it would already be reflected in the price. But I'm concerned about two things. First of all, I'm concerned about the size and the composition of the cliff. It's large, at about 4 to 5% of GDP. This would be the largest fiscal drag in the post-World War II period. In terms of the composition, it hits the economy where it's most vulnerable, which is the consumer. But I'm also concerned about the fact that despite all the talk and all the discussions, I don't think it's reflected in the price. And the reason I don't think it's reflected is that most advisors, most institutional investors seem to believe there's a last-minute compromise. And when we talk to people in Washington, they put a much higher probability of going over the fiscal cliff than I think investors are putting on right now.
You're not feeling there's going to be a compromise?
I hope there is. And I think the truth is nobody knows. It will very much be determined based on the outcome of the election. What is the composition in Washington? But I think the challenge is you do have the parties running on very different platforms. Unless you come out of the election with a clear mandate, there is some risk that given the differences in viewpoints and the fact that there are only 7 weeks with which to settle this, that you may have to go into 2013 before you eventually reach that compromise.
Okay, so BlackRock, iShares, being the largest provider of ETFs out there, give us 2 recommendations as far as positioning client portfolios as we go into the end of 2012 and into 2013.
So I'll give you 2. I think they both fall under the heading of getting a bit more defensive in thinking about some of that downside risk and how to cushion it. So one is thinking about minimum volatility portfolios. These are portfolios that are not cap-weighted in design. They're, as their name implies, try to minimize the volatility for a universe of stocks. And in addition to producing better, or at least historically producing better risk-adjusted returns, they have shown some ability to also cushion the downside. So there are funds out there like our U.S. minimum volatility, the USMV, also a global portfolio, the ACWV, that investors may consider is substitutes for a cap-weighted portfolio.
So you're in the market, but there's not as much weight.
You're in the market, but with less volatility than you might have if you simply owned U.S. large caps or if you owned ACWI. The second notion is, the U.S. has been sort of the safe haven the last couple of years. We've been the place to go when anything bad was happening in the world. Now we've got this unique situation where we may be the epicenter of whatever is happening, in this case, the fiscal cliff. So I think for investors that are overweight the U.S., it's been a good ride. This is probably a time to start to reduce that overweight and consider looking outside of the U.S., particularly for dividend yield, where you can access higher yield for a lower price than you can currently in the United States.
Where? Where do you go?
So there's several ideas, one of which is looking at places like Northern Europe, Southeast Asia. You can access these markets through our international dividend fund, the IDV. Another, emerging markets. Right now, some very good yields, attractive yields at a good price in many emerging markets. You can access companies that are focused on dividends in the EM space.
Corporate balance sheets looking great over there.
Balance sheets are clean, as they are in the U.S. in fairness, but this is one of the things we're comfortable about is that companies can maintain that dividend stream. And as I was going to say, you can get the EM exposure through the DVYE.
Russ, thanks for your time. Really appreciate your ideas.
Thank you.
This is Tom Lydon for ETF Trends.